Hello everyone, I'm Devon Coombs, and today I'm going to be covering a lecture on an introduction to bond valuation. The goal of this lecture is to be able to differentiate between bonds and notes payable. At the end of this lecture, you'll be able to understand the terminology used when valuing bonds, be able to conclude if a bond is sold at par, premium, or a discount by comparing the stated rate to the market rate, and be able to calculate the present value of a bond using Excel and net present value tables. We're specifically going to be covering traditional bonds with semi-annual payments and an end redeemable amount at the end of the bond term. We're not going to be covering serial bonds or any other type of bond arrangements in this lecture. We're going to be discussing these in three sections: background, terms, and valuation. Feel free to jump to each section based on your knowledge level and what you've already committed to or what you already understand. So let's discuss some background on what a bond actually is. A bond is a legal contract between a holder and an issuer. A holder is a person or entity purchasing the bond, and an issuer is a company seeking financing. They're traded on an open market. They are an issuer's written promise to pay an amount with interest, generally semi-annually, and they're typically issued for large projects requiring large sums of money. Most of my clients have issued them for either business combination purposes, acquisitions, or to purchase large amounts of land or plant property and equipment. Typically requires periodic interest payments, the semi-annual interest payments we talked about, and traditionally you'll see this piece of paper. This is what the bond looks like. Nowadays, given e-trade platforms, you may not receive this bond, but you still can, and I remember some of my first investments, I actually had the physical bond itself, which we're going to cover what that looks like and all of the different areas of detail on that bond in a later slide. So when we're going over this next section, I'm going to give it as a multiple choice question, which might be similar to what you would see on an exam. We're going to discuss why each answer is either right or wrong, and I encourage you to do that on each of your multiple choice questions. This will help you become an expert in the subject by being able to explain why an answer is right or wrong. So multiple choice are some of the best learning vehicles for you in your accounting and finance education. So A company borrows $10 million from a bank at 6% annual interest, which it will pay back monthly over the next 10 years. So is this a bond? So if we go back to the previous slide, we know that a bond needs to be traded on a public market. So we know that this isn't traded on a public market. This seems more like a notes payable to me, right? This is a bank. It's a long-term notes payable. It's over 10 years. And a company's just borrowing the $10 million and paying that interest. So I would say this is not a bond. This is likely not the answer because it's not on a public market. B, a company provides $10 million to a real estate developer for a piece of land. This seems more like a sale of land to the company or purchase from the company's perspective. So this would not be a bond. C, a company issues $10 million in debt on the open market at 6% interest. It will pay the interest semi-annually, and the principal is due 10 years from the borrowing date. This seems to have all of the elements of a bond, right? It's on the open market. We have a principal amount. We have interest. It's semi-annual. So this seems like the best answer, right? And so C seems correct. And then D, a company lends $10 million in debt to a private investor, which the private investor will pay back in 1 year along with $100,000 interest. So this isn't on a public market. This seems more like a notes payable to me because it's not on the public market. So that's the key difference here. So C is the correct answer. And please go back through this question as many times as you need to in order to understand why that is. It has all the elements of a bond. So terms, bond basics. Now that we've talked about the background, I think we're all ready to learn some of the terminology we need to know for valuation. Before we start the valuation process, it's essential that you understand these terms. Issuer, the company selling the bond. So the issuer and the holder, we talked about them briefly in the background section, but let's go into a little more detail. The issuer is seeking cash up front, generally for a large project. That means they don't have the cash today. There's two ways they can finance themselves, right? Through selling equity, selling more of their company to get more owners, or issuing debt other than just generating revenue through typical operations. So issuing equity or issuing debt. If a company wants to issue debt, they need to find someone who will buy that debt, give the money for that debt in exchange for principal and interest payments. That's the holder, right? So the holder is looking for an investment vehicle in order to make money on their money, while the issuer is looking for money up front because they believe they could make more money than the interest expense itself. So it's always important to know who we're doing the accounting for, the issuer or the holder. In this case, when we're looking from a liability perspective, it's from the issuer's perspective because we owe that money to the holder. From the holder's perspective, it's an investment perspective, which we'll talk about in intermediate accounting. So the maturity date is the date the principal can be redeemed by the holder. So if the principal can be redeemed in 2025, that's the day the holder can get back all of its principal, which is also known as the face value of the bond. That's the amount on the bond that the holder can expect to get. It's actually on the face of the bond, and we can expect to receive that. It's also known as the principal payment. Then there's these last two pieces which are essential. The stated rate, we're going to talk about market rate. Stated rate is also known as a coupon rate, a nominal rate, and a contract rate. These are all the same. They all have the same meaning. Don't get confused. If you see any of them on a test or exam or in your textbook, just assume they mean stated rate. This is the annual interest payable semi-annually on the bond itself. It's locked. It can't be changed. We're going to talk about that on the timeline on the next slide. This is different than the market rate. The market rate changes based on day-to-day market adjustments. With recent developments in the market, interest rates have been going down, right? So someone who issued a bond or a company who issued a bond in January would have issued it at a rate likely matching the market, which would be a lot higher than the rate today. So that stated rate, which is on the bond, is locked while the market rate fluctuates. That difference leads to differences in bond valuation, which we're going to be covering on the next slides. That's the key here. So keys on this slide: issuer and holder, and the stated rate versus the market rate. So let's look at what that would look like on a bond itself. So here is the face value of the bond, also known as the principal. You can see the stated annual interest rate, and hopefully you can see here that this is why we can't change it. It's locked on the agreement. It's locked on the contract. It's always going to be paid out. So the market rate might change, which may change the value of the bond, but this amount is locked. We also have the issuer name, right? This is the Dow Chemical Company. The issue date. Bonds interest payments are locked at their issuance rates, the stated rate. We cannot stress this enough. And so because of this, we're going to have a timing difference. And now we're ready to jump into our valuation discussion. So our valuation discussion's really going to be focused on this difference between the market rate and the stated rate due to the difference in the timing of the purchase of investments. So let's use this example, and I'm going to walk through a timeline below. So a company is issuing 1 million AAA 10-year bonds at a 3% stated rate paid semi-annually. In this above example, the 3% rate would stay locked throughout the entire life of the bond. However, the market rate, let's say it's a AAA 10-year bond, you can look at the rates on the slide here, fluctuates potentially daily, resulting in price adjustments to the bond. So let's use this timetable, and this is using the rates in that hyperlink so you can really see the illustration. But let's say January 1st, 2020, a bond is approved by a board and the market is 3.04%. So that market rate's locked onto it. We decide we're going to issue bonds at 3.04%. On April 1st, 2020, the company issues and the board approves the bonds. So at this time, the market rate is 2.76%, but our stated rate, we're saying, is 3%, right? So on January 1st, we were really close to that market rate, issuing it at 3%. And now the market rate has dropped significantly. At 0.24% is pretty significant. So from an investor perspective, these bonds are really a good deal, right? Because we, as an investors, can get more interest by buying these bonds than the market is currently offering on April 1st. On May 1st, a holder of the bond sells the bonds to another investor, and the market rate's 2.24%. So they can sell it on the public market to another investor, and as that interest rate drops, the public market's interest rates drop, the valuation of the bond will increase, resulting in a premium on the bond. And the fluctuations go both ways. So hopefully this timing really helps illustrate how when the market rate changes, the value of the bond changes, but that 3% stated rate won't change. That 3% stated rate is always going to be locked for the life of the bond unless those bonds are retired. So let's talk about par, discounts, and premiums. It's really simple. Based on the previous fact pattern, right? If the stated rate is equal to the market rate, if we issued at par or issued at 3% and the market rate's 3%, the valuation conclusion, we just issued at par, and the accounting is going to be relatively simple. We're going to receive cash, and then we issue bonds. There's going to be no premium or discount. And we'll go over journal entries in future slides. The focus of this is really understanding the relationships of the financial transactions. The stated rate is greater than the market rate, then it's a premium, right? Because the company is able to sell bonds or is paying more interest than the market is currently paying. So investors are willing to pay more money for those bonds because they have more interest on them. If the stated rate is less than the market rate, we're selling those bonds at a discount because the market has more attractive rates than the current bond has. So the market fluctuates, but the rate stays the same. So let's say 3% stated rate, but the market rate is 3, 4, and 2%. Our conclusions are relatively simple, right? Par if the 3% and 3% remain the same. Stated rate is less than the market rate, it's going to be a discount. And if the stated rate is greater than the market rate, then it's going to be a premium. So I encourage you to go through these slides and make sure you're able to test and understand why we reach these conclusions. So just go back and check if you can reach these same conclusions. So let's talk about net present value. Right now we've gone through, simply we know if we are buying or issuing bonds at a discount, premium, or at par value, but now we need to know how to value those bonds. So from a valuation perspective, I have to ask you, would you rather I give you $1,000 today or $1,000 a year from now? Purely hypothetical. I'm not going to give you the money. My apologies. I don't have that kind to be thrown around. But from a hypothetical perspective, would you rather have it today or a year from now? Today, the money is worth more than a year from now. And this is due to inflation, risk, and opportunity costs, which are reflected in market interest rates. So if I give you $1,000 today, you could use that to invest in your education. You could use that to invest in bonds even, or in the stock market, or at the very least in a high interest savings account or money market account. And so that money today is worth more than $1,000 a year from now. So net present value, we are going to be using it to determine what I would pay today in order to receive that $1,000 a year from now. We can use this concept all throughout finance. It's a key concept. Highly recommend memorizing it, learning it, spending time on it now before the rest of your classes, because it's going to come back over and over again. So bonds must be valued at net present value, as well as most long-term liabilities. So we're going to be looking at two cash flows for bonds. We have the principal payment, which we need to bring back, right? It's the same question, $1,000 today versus $1,000 a year from now. Same question if we say, well, what if I gave you $10 million 10 years from now? Well, what would that be worth to us today after taking into consideration risk, inflation, etc.? But we also have interest payments. So what are those periodic interest payments worth to us today? And so we have the return of the principal, the present value of a future cash flow. That's what that's called, the future cash flow being the principal, and then us present valuing it. And then we have the interest payments, which is a present value of an ordinary annuity, or an annuity that we're getting, annuity being the same payments over a period of time, so the semi-annual payments at the end of a period. So at the end of 6 months, we'll receive that interest payment. So there's 3 ways to calculate net present value. We're going to go over 2 of them today. We can calculate it algebraically. There's present value of principal and present value of the interest or the annuity. We're not going to go over that in this lecture, but just know it's available and generally covered in business calculus and finance courses. Using a financial calculator or Excel, I'm going to go over an example in Excel and include the Excel workbook in this presentation, and present value tables, which we're going to go through today as well, which will be one of the last slides. So let's go over Excel. There's facts and circumstances here that you'll always have these facts and circumstances, and you'll have to be able to identify the variables. So we have a $1 million bond, 10 years, with a 6% stated rate paid semi-annually. The valuation, let's value them, these bonds, at market rates of 4%, 6%, and 8%, because they can vary, right? And so we have to identify each one of these variables. So the future value is the principal payment. That's not going to change in either scenario or any of these scenarios. $1 million. The annual term is 10 years, but we know we're looking at it from a semi-annual perspective, right? We're actually looking at semi-annual periods. So we have to multiply this by 2. So that's where we get our 20 semi-annual periods. The stated interest rate, that's the interest rate on the bonds, is 6%. So if we divide that by 2 periods, right, because we're looking at semi-annual interest payments, so multiplying the term into 20 periods, but these are 20 periods at half the interest rate, so 3%. And what kind of interest would we be looking at? We take the 3% and multiply it by the 1 million to get our 30,000. Then we would look at the market rate being 4, 6%, or 8%. Everything above this is the same. This fact pattern won't change. The market rate is what changes the valuation, which results in different semi-annual market interest rates of 2%, 3%, 4%. These are just half of the market rates listed here, and we can see the bond valuation and premium par discount conclusions. So again, we can go back to our original slide of if a valuation is at 4%, the market rate's at 4%, but our stated rate is higher, it makes sense that we have a premium. And when you're doing your questions, make sure that it logically makes sense. Oh, our stated rate is higher than the market rate, so the premium makes sense. My calculation is probably correct. While in this case, market rate equals the stated interest rate, 6%, we have par. And then if the market rate is, in this case, the market rate is greater than the stated interest rate, we'll have to sell our bonds at a discount, which means on the market, in this case, right, with an 8% market rate, when we issued at 6%, means we would be selling our bonds for $864,097. So we can see how the market will fluctuate the value of the bonds. And for accounting, which we'll go over in more detail, this is focused on valuations, we'd have either a premium or a discount on our bonds that relate to these amounts. But we'll go over that in future lectures. Focus here on purely the valuation. So let's look at another illustration. If you want to see the underlying formulas using this financial calculator, it's included in the slides attached to this presentation as well as the Excel sheet. And we can go over those formulas in another lecture as well. So let's look at present value tables. Present value tables, we have facts and circumstances, the exact same, but we're just going to look at the 4% rate. So a lot of times you won't have Excel available, especially for tests. So when we don't have Excel available, we're generally going to use present value tables, especially if we don't have a financial calculator as well, and we don't have the time to do the calculations algebraically. So these tables I've included them here. They're in most of your textbooks, and generally will be included on your exams if you're tested on this kind of equation or question. But what we would have to look at is, this is the amount of periods, and this is the interest. And I've just cut an excerpt. It will be much greater if you click on the link here. And so you have the 2%, 3%, 4%, 5% on the link here. And then we just go and say, okay, we know that it's a 10-year bond, but it's semi-annual. So we have 20 payments. So we go to 20. And then the valuation, or the market rate, we're using the market rate for the valuation here, not the stated rate, is 2%. Because it's semi-annual, so we divide the 4% by 2. We multiply the periods by 2, divide the valuation or market rate by 2. We get 0.6730 here. It's that simple. We just follow the chart. The hardest thing here is knowing that we're using the market rate, not the stated rate, and then to make sure we do our multiplication on the periods and the division on the percentages. Then we just multiply that by the principal amount, which gives us the $673,000. So in other words, like logically, what does this mean? This means that the present value of the $1 million of the future principal is worth $673,000 today. So based on this, if we weren't getting interest, investor would purchase just the future principal amount for $673,000 today. So it goes back to that $1,000 today for $1,000 tomorrow question. Well, which would you prefer? Well, in this case, we'd be willing to pay $673,000 today for $1 million 10 years from now. So those semi-annual interest payments are going to have the same facts and circumstances, right? 20 periods, 2% market rate. So we know that we have $30,000 as interest, right? The $30,000 is the 6% divided by 2 multiplied by the 1 million. So 6% divided by 2 is 3%, multiplied by 1 million, that gives us $30,000 interest payments semi-annually over these 20 periods. And so that's what we're calculating here using what's called the present value of an annuity table. Another way you can get tricked up is the present value table of a future cash flow being here for the principal amount is a different table than the present value of annuity table, and so make sure you're using the right tables for your valuation. So we're looking at this interest payment. We'd multiply it by the factor we have here in order to get our $490,542. The present value of the $30,000 interest payments is the $490,542. So in other words, if we took the principal out of the equation, you would be willing to pay $490,542 today in order to receive $30,000 of interest over the next 20 periods or 10 years semi-annually. So what we get as a bond is both of these, right? We get both the interest payment and the principal payment. So we just need to add these together. The $673,000 and the approximately $490,000 gives us a total present value of the bond of $1.163 million. That gives us a premium over the face value on the bond of $163,542. That's what would be paid to the issuer, what the holder would pay. That's the cash they would receive, and then we'd have a debit to cash, credit to bonds payable, and a premium on the bond to credit to the premium. We're going to go over those journal entries in detail when we have a little more time in future lectures. One last observation here. So this is going to be a little different than our previous slide calculation here, 514, 542, and that's just rounding differences. The financial calculator is a little more accurate, but it's not significant, not material, so don't worry about that. If you were just have an eye for detail, wanted you to be aware there's a difference there. So if you have any questions, please feel free to ask them in the comments below. Don't hesitate to reach out to me. I hope you all had an excellent time over this lecture, and have a great day. Bye-bye.